H.L. Hunt built one of the largest private fortunes in American history through oil discoveries in East Texas during the 1930s, and at his death in November 1974, he was widely regarded as among the wealthiest individuals in the United States. His sons Nelson Bunker Hunt and William Herbert Hunt inherited both enormous capital and an appetite for large concentrated bets. Bunker, as Nelson was known, had pursued his own oil ventures separately from his father's main company, including concessions in Libya. When Muammar Gaddafi's government nationalized Nelson Bunker Hunt's personal Libyan oil interests in the early 1970s, an experience that cost him hundreds of millions of dollars by most contemporary accounts, he later said it reinforced his conviction that assets held at the mercy of foreign governments and paper currency backed by nothing offered no real security. The macroeconomic setting of the 1970s gave the Hunt thesis a surface plausibility that attracted serious capital. The United States had closed the gold window in August 1971, ending direct dollar-to-gold convertibility and severing the last formal link in the Bretton Woods system. Consumer prices, as measured by the Bureau of Labor Statistics Consumer Price Index, rose at annual rates above 10% in both 1974 and 1979. Silver, like gold, had long been treated as an inflation hedge and a store of value, and in the years after 1971, its price had already begun rising from historically depressed levels. Bunker Hunt publicly stated on multiple occasions that he expected paper currencies to depreciate sharply, a position he maintained even as it led him into one of history's most spectacular trading disasters. The Hunt accumulation began in earnest around 1973 and 1974, initially through futures contracts on the Chicago Board of Trade and the Commodity Exchange in New York, known as COMEX. Rather than closing contracts as expiration approached, as most speculators do, the Hunts repeatedly took physical delivery, pulling actual silver bars out of exchange-registered warehouses and in some cases shipping metal to Switzerland to remove it permanently from exchange inventories. They later attracted Saudi investors who organized an entity called the International Metals Investment Company, or IMIC, which expanded the capital base available for accumulation well beyond what the Hunts could deploy alone. A 1980 staff report by the House Subcommittee on Commerce, Consumer, and Monetary Affairs estimated that the combined Hunt family and IMIC positions in physical silver and futures contracts had reached the vicinity of 200 million troy ounces at their peak, a figure the Hunts themselves disputed as an overstatement. Through most of the 1970s, silver traded in a range roughly between $2 and $6 per troy ounce. Starting in early 1979, as U.S. inflation accelerated and geopolitical anxiety spiked with the Iranian Revolution, the price began rising sharply. By September 1979, silver had climbed to approximately $16 per troy ounce. The move attracted momentum buyers with no connection to the Hunts, further amplifying the trend. Jewelers, photographers, and industrial manufacturers who depended on silver as a raw material began reporting shortages and rationing purchases, which added physical demand pressure on top of the speculative buying already underway in futures markets. By mid-January 1980, silver had reached approximately $49 per troy ounce, a price that contemporary press accounts sometimes rounded to $50. The gain from early 1979 represented roughly an eightfold increase in 12 months. Gold peaked around the same period, touching $850 per troy ounce on January 21, 1980, as investors globally sought hard asset protection. But silver's percentage move was far larger and far more concentrated in the hands of a small group of actors. The paper wealth implied by the Hunt and IMIC key holdings at those prices was, by some contemporary estimates, in the billions of dollars, but it existed only as long as buyers remained willing to pay those prices. COMEX directors had been watching the accumulation of silver positions with alarm for months. In early January 1980, COMEX adopted emergency rules that imposed strict ceilings on the size of any single trader's net long position in silver futures and restricted new contracts to liquidation purposes only, meaning contracts could now be opened only to reduce existing holdings rather than to add to them. The Chicago Board of Trade adopted similar restrictions. The practical effect was that the pool of buyers capable of absorbing additional silver supply shrank dramatically overnight. With the mechanism for sustaining the price now removed, the direction of the market reversed. The price had been declining since mid-January, but the defining break came on March 27, 1980, a date that became known in markets as Silver Thursday. That morning, the Hunt brothers were unable to meet a margin call from Bosch, one of the largest brokerage firms in the United States at the time. Word spread rapidly through trading floors that the Hunts were in default on a margin obligation of substantial size. Silver fell to approximately $10.80 per troy ounce that session, roughly a 78% decline from the January peak in fewer than 11 weeks. Federal Reserve Chairman Paul Volcker was monitoring the situation closely, according to contemporaneous accounts. concerned that a failure at a major broker-dealer could cascade into a broader credit contraction at a moment when the Fed was already tightening policy aggressively to control inflation. The resolution that prevented a systemic collapse was not a direct government bailout, but a privately negotiated rescue. A consortium of American banks extended a credit line to the Hunt family totaling approximately $1.1 billion, secured by the Hunt's oil properties and real estate holdings. The Federal Reserve, while it did not lend money directly to the Hunts, made clear to lenders that credit extended for speculative commodity purposes should be curtailed, and its officials remained in close contact with market participants throughout the crisis period. The bank loan allowed the Hunts to meet their immediate obligations and avoid a forced liquidation that multiple analysts at the time believed could have impaired one or more major broker-dealers holding silver-related exposure. Within months of Silver Thursday, the House Subcommittee on Commerce, Consumer, and Monetary Affairs convened hearings to examine whether the Hunts and their partners had attempted to corner the silver market. Bunker Hunt testified and argued that his purchases had been motivated purely by a desire to protect wealth against inflation and that he had no intent to squeeze other market participants. Regulators and independent analysts found this explanation difficult to reconcile with the systematic physical delivery strategy, the offshore partnership structure through IMIC, and the scale of the accumulated position, but proving intent to manipulate under the commodity law that in effect required a high standard of evidence that investigators found difficult to meet in a criminal context. The financial and legal consequences took nearly a decade to fully resolve. Nelson Bunker Hunt filed for personal bankruptcy in September 1988, listing liabilities far in excess of his remaining assets. In 1989, both Bunker Hunt and William Herbert Hunt reached a consent settlement with the Commodity Futures Trading Commission, agreeing to pay civil penalties totaling approximately $134 million without formally admitting to the charge of attempted manipulation. Separately, a civil lawsuit brought by Minpeco, a Peruvian silver trading company that suffered substantial losses when the price collapsed, resulted in a federal jury verdict finding that the Hunts and IMIC had conspired to manipulate the silver market. The damages awarded and the amounts ultimately paid after reductions and appeals have been reported differently across sources, and the full financial resolution of the Minpeco litigation extended over several additional years. The Hunt episode accelerated lasting changes in how commodity markets are regulated. The Commodity Futures Trading Commission, which Congress had created only in 1974, was given strengthened statutory authority in subsequent legislation to impose and enforce speculative position limits, establishing ceilings on how large any single market participant's net position can grow relative to the overall market. Exchanges adopted faster procedures for declaring emergencies and restricting new positions when concentration threatened price integrity. These frameworks were later debated and extended in the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act, which directed the CFTC to set formal speculative position limits across a broader range of commodity futures contracts, a rulemaking process that faced years of legal challenges before being finalized. The Hunt Silver Corner illustrates a pattern that reappears across financial history: a highly concentrated position funded substantially by borrowed money, amplified by momentum buyers who do not understand the source of the price trend, and then unwound in a disorderly way that damages parties far beyond the original speculators. Understanding how position concentration builds and unravels, and why regulators often intervene only after the price has already broken, is useful context for anyone trying to understand how commodity markets, and by extension any market for a finite asset, work under stress. The rules that govern modern commodity trading are in significant part a product of what went wrong in 1979 and 1980, and the debate about where to set position limits has never fully gone away.